everyone. Welcome to our Savvy Ladies session today. We're thrilled to have you join us. I'm Judy Herbst, the Executive Director of Savvy Ladies, and it's really my pleasure to welcome you here today for this really exciting session with Katherine Sayer about insurance for your life. Like, what is the right stage and right type of insurance you need? I think we're going to have a wonderful conversation today. We're going to give everyone another minute or two to enter the room. We had a really amazing response to this topic. Over 100 people have registered. So we know it's a very topical question. And we have an expert here, a professional who will answer your questions. If you have any personal questions, I think you all know, Savvy Ladies, we have a helpline, a free financial helpline. Feel free, I'll drop the link in the chat, but you can get matched with a certified financial professional or to help you and get paired for a one-to-one conversation for them to answer your questions. So without further ado, we're really at the top of the hour. Katherine, I hand it over to you to share your expertise with us today.
Great. Thanks, Judy. It's wonderful to be here. And thanks everyone for taking the time to join us today and to find out about protection for the unexpected. So I'm Katherine Sayer. I've been helping clients to protect their money, their families, and their businesses for over 25 years. So I've had the really interesting experience of seeing people start when they're younger, and as their families and their lives evolved, I've seen the way some of these policies have worked for them while they're alive as well. So that's really been a very rewarding experience. Now, we all know people have different needs. There's a wide spectrum of people on this call from different ages, different backgrounds, different interests. So I'll try to do my best to give you an idea of what's important at different phases of your life. So people hear the word insurance, there may be some stigma attached to it, but the way I think about it is it's peace of mind. If you know that space is covered, you don't have to worry about it anymore. You know, you don't have to save as much money if your income is protected by disability insurance. You know your family will be okay. You know you've started saving for retirement and that's protected. So I like to think of it as the peace of mind solution to the unexpected things that can come up. We never know when it will. So we really can't predict the future, but we can prepare for it. And that's really what this is about. So we'll talk about having protection for you, for your family, against the contingencies of life. We call it the what ifs. What if, what if, what if? Unfortunately, there's been an awful lot of that in the news lately, and it is really frightening to see what can happen to people. So we're going to focus on life insurance, but I really do want you to know about other insurances that are important as well. So I'm going to go to the couple of slides. I'll try not to overwhelm you. Okay. So we're talking about protection for the unexpected. And just a few housekeeping situations. We have compliance rules. Okay. Let's this work, of course. This is not going down. Uh-oh. 1 second, this isn't, I'm in share mode. It may, oh, there we go. Okay, so this is who I am, CLU RICP. That means I've taken a lot of courses and past exams in business, retirement, estate planning, and also RICP is income for retirement. Disclaimer, I'm based at New York Life. I do work with other companies as well because my role is really to find the best products for my client. That's really their disclaimer. So we're going to look at this. This is what people, most of the time want to know when I meet them. First of all, why do I need it? How much do I need? And what kind of insurance should I get? And at what point should I get it? So I think that's it. So basically, you have a financial life and financial strategy. And the base of it is the protection. And that's really where a lot of insurance comes into play, because you need this strong foundation in order to get to the top and your eventual goals, which, may be retirement for some, A lot of people are very interested in a legacy for their families, but along the way, a lot happens. You might be single and you don't have the expenses of children and family and all of that, or married with children. But whatever it is, you need to protect what you earn, what you already own, and your debt, because if anything happens to you, someone's got to pay those debts. So this is the foundation of it all. And you may be on different steps as we go along, but wherever you are, you need to protect what you've got at that point in time in order to prepare for the future, which could be major purchases. You want to buy a house or another house, a yacht, whatever, and emergencies that come up. We all know there are medical expenses that just aren't covered, education for the kids, and making sure you have enough money to save for retirement, which also has inflation involved. So what you are spending today, if you figure what it will cost, not maybe with the inflation we're feeling, but an average of 3%, it will definitely be more than you have now. So I think the beginning of things is what is your income. So protecting that is vital. Unless you're already retired or you have enough money to say, okay, I've got enough money, I don't have to worry, I can retire today, then you're okay. You don't really need insurance for that. But this isn't, for most people, the most important asset you have is your ability to earn a living. So the question I would put to you is, what would you do if you couldn't work because you were sick or disabled in some way by sickness or injury? So it happens more often than you'd think. I have to tell you just one quick story. When I first started in this business, which was probably 30 or so years ago, one of my early clients was a young attorney, and you knew that this guy was a rising star. Unfortunately, he came down with a brain tumor, and he had disability insurance. So he was able to survive financially, get help. I'm still in touch with him today, by the way. We speak fairly often. He's okay. I mean, he's not really okay, but he has carved out a life for himself, doing what he really wanted to do, which is photography. So he's been doing photography for schools and parties and this and that, because he can do that when he has the energy, although he certainly could not work as an attorney. So, that story really hits home for me, because I know how grateful he is that he got this coverage. So it also impacts your family, because if you can't work and you have a family, then they will also have their lifestyle compromised. So we protect all sorts of things. I mean, I was really glad when I dropped my phone in the toilet that it was okay, because I had insurance. I have to pay a gazillion dollars for a new phone, but that's nothing. What's really important is your earnings power. So over the course of your life, just think about it. If you earn $100,000 a year for 30 years, you've got a $3 million asset. That's a lot. So that's why it is important to protect that asset. So there are a couple of ways to do that. And we can take a look. One is savings. You have enough savings to retire now, then you're fine. Okay, but most people don't. Social Security. Social Security disability really does not pay that much, especially if you have not worked very long. It's also very difficult to qualify. I mean, you have to prove that you will never be able to work again at anything, and there's about a 12-month waiting period. So fortunately, it's there, but it usually is not enough to maintain any kind of a lifestyle. Group disability. I don't know how many of you work for companies. If you do, hopefully you have a group disability insurance policy. Basically, it's a large company that would have this. Some smaller companies don't. People that start their own businesses have to find their own. But if you do have it, I would really encourage you to get as much as you can. But understand that this is not really your insurance. It will not go with you if you change jobs. So if you decide you want to start your own business or work for a startup, you probably won't have any. And that, leads us to, getting your own insurance. That's individual disability insurance. This is your own policy. You buy it yourself, you own it, you control it, you figure out how much you need, and it will always be there for you. And I think what's so important is that, one, when you're younger, it costs a lot yet less. That's one point. But you also need to qualify, and this is called underwriting. When you apply for most individual policies, the insurance company wants to know you're a good bet, that you're not going to be more of a risk than they want to keep on. Therefore, they do check your medical history, and that becomes pretty important when you want to buy your own policy. Again, that's why I encourage everyone to get something in place when you're younger and healthier, because, again, I've seen people 50 years old, great, I'm going to start my own business. Oh, but I have a terrible back, and they really can't get their own disability insurance. Plus, it's very expensive as you get older. So you put that into place as a kind of a nugget. If you have what I call the right policies, you would be able to enlarge it without underwriting if you leave a company or your income increases. So I think to start a policy as soon as you can is really a big help, big peace of mind. Again, we're buying peace of mind here to your future, your future comfort. So that is really important during your working years. But, after you've worked, you've retired, you've saved enough money, everything's great, you're doing whatever you always wanted to do, you're traveling. The next thing is the cost of a long-term care experience. That's a chronic illness. Long-term care is really chronic, means it goes on, but it's not medically something that will get better. I mean, how many of us have seen this in our own families? People need to have someone take care of them as opposed to medically cure them. It is very difficult. I've been doing long-term care insurance again for 20 years, and I am now seeing the claims come in. And I see how much it helps the families and the people to know that a lot of this cost is covered and they don't have to personally do whatever it takes to keep somebody maintained. I mean, you need someone maybe bathe you, take you to the bathroom. I don't know. It's not a comfortable situation for many people. So then you may want to hire someone, and that's very expensive. So it's a great impact upon your family, emotionally and psychologically, as well as financially. So by taking care of some of the financial part, it really relieves the family to go sit with you, watch Netflix, and not really worry about getting you dressed or taking you to the bathroom. So that's one of the, I think one of the greatest benefits of having that cost covered. It may not cover all of it, but it will cover a lot. And so who needs long-term care? Actually, most people do. 70% of people 65 or older need some kind of care. And, that's a sobering statistic. I understand that. But unfortunately, it's been shown by the U.S. Department of Health and Human Services. So it's something that will most likely happen. And you have to figure out, how am I going to take care of it? Who is going to be in charge of me? Are my children going to take care of me? Is my spouse? I mean, let's say you're 80 years old. Your spouse weighs 200 pounds, you're a little petite woman, not so easy. So that is very difficult for someone to actually have a caregiver within the family. And of course, it happens very often. And where would you rather be? Home. Most people would prefer to be at home. And the statistic is that 90% of people who have the need for long-term care are home. And then the cost is pretty substantial. If you have to hire someone to pay for your care, then it is a lot of money. To just give you an idea, this varies in different parts of the country. So if you needed a year of healthcare, I'm looking at New York City. It's less upstate, it's less in others. Some places which you would not believe are more than New York City. But this number, $56,000, that's really based on a very small number of hours of care. If you figure that the cost of a nurse, not a nurse's aide, but a home health aide in New York is $27 an hour. the national average is $25 an hour. So if you figure that $25 an hour, times 8 hours is like $200 for one shift a day. So that really adds up to more than $56,000 a year. I don't know where they got that from, but I think it's based on limited number. Generally, there is kind of a continuum of care. When someone first needs care, they may have a little balance issue. They may need help getting dressed or getting out of a chair, but they could still stay at home pretty well. Then sadly, they may need more care and it's not easy to manage. So they may end up in assisted living. They're still somewhat able to care for themselves. So that's why it's called assisted living. They do have some ways of getting around, mobility, be it a wheelchair or whatever, but they're not totally incapacitated. Then sadly, as time goes on, they may need to be in a nursing home, and that is incredibly expensive. And I know this is a true number. $175,000 a year for a nursing home. So the cost is pretty substantial. And, it's something to bear in mind that could happen to you and your family. So how do you pay for it? I think one of the most common misconceptions is that Medicare or your insurance will pay for it. It absolutely does not. If you look at the Medicare booklet, in big letters, it says, this policy does not pay for long-term care. That means Medicare will pay for you if you are in a situation or illness where you can get better and you need medical care. It will pay for you in rehab, for example, because that's geared for getting you out. But at the point that you just need care to maintain you, and that's called custodial care, it will not pay. And that's why, it's important to have some kind of plan. Medicaid does have some provisions for paying for long-term care. However, you really have to be pretty impoverished to be able to access Medicaid. You're only allowed, and again, these numbers vary all over the place from state to state, but basically you have to be fairly impoverished and show that in order to qualify. So for example, you're only allowed to keep $2,000 in assets. And if you're married, your spouse can have no more than $148,000 of assets. So if you're older and you save, you're certainly going to have more than that, most likely. And then your income is also captured. So it's not easy to qualify for Medicaid. If you do want to do all sorts of legal machinations, you must have everything out of your control for 5 years. Else it's considered that it's still your asset and that will be captured. So that may work for some people, but it is really difficult. And out of pocket means you're going into your own money at, a few $100,000 a year, which can be devastating to your retirement, to your spouse's retirement. If you're not retired yet, and things do happen to younger people, sadly, then it's going to destroy any hope for retirement in terms of, your own. And then generally we look at long-term care insurance, some insurance that will help with a great deal of it, and maybe you'll pay for some of it. And that, again, that's up to every individual as to how much they need in terms of what assets they've accumulated that they can divert to that. So, again, these policies are designed individually. There are policies now that combine life insurance with long-term care component that are very appealing to people because they know no matter what happens, their family will get the money if they die, if they get sick, and then they can usually get their money back that they've paid in premium. So it is a study, which we really don't have time to go into now, but it's something that most people would have to work out individually, find an advisor that has experience working with long-term care, because it is a process that one goes through in terms of planning. So the next step really brings us to life insurance. And life insurance does more than protect your family, but that is generally the basic need. So it gives you the peace of mind of knowing that your family's going to be okay no matter what happens. And I think, that's really important. So the same questions really arise with life insurance as with any other insurance. That is, what do I need? How much do I need? What does it cost? So, but it also has a lot of living benefits so that it can help you through the various stages of your life, depending on what type of insurance you get. So this is really your standard of living, so to speak. And as time goes on, your income should increase, your assets will increase. And it's a matter of where you want your family to be if you're no longer there. So after, some point in time, if you are not around, and it could be disability also, not necessarily death, that would prevent your family from having the benefit of your income. So what happens down the road? Let's see, your income stops. What assets would your family have in order to continue? Generally, we would hope as time goes by, they have more, and maybe you don't need to insure as much. But again, that's something that has to be really worked out. And I think, checking that in an annual or so basis and making sure that your insurance keeps up with what you need. And so this really protects your family's standard of living. Life insurance replaces your income. And again, that would pretty much define how they're living at that point. So there are other aspects too, because if you're married, maybe, or let's say you're stay-at-home mom, if your spouse were to pass away, you would have time to figure out what to do, possibly start working. And conversely, if you're working and someone else is home, you want to make sure also that if something happened to that person, you would have the wherewithal to hire someone to take care of the kids, maybe stay home for a year or so and take care of the kids, because it is a very difficult situation. So life insurance does a lot in terms of peace of mind at a very bad time. So we pretty much said, why do I need it? I think, to keep yourself going and your family going. And, the question most people ask, how much do I need? Well, basically, you would need enough to make sure that your family is protected. And there are different ways to do that. Let's see. So I don't want to get too complicated here, but basically, if you figure your family needs $100,000 a year, that's replacing your income. And generally, rule of thumb is that if you take 4% of your money, considering inflation, then that will last for 30 years. So by that standard, you would need to have over $2 million of life insurance to be sure that your family had the equivalent of $100,000 a year of coverage. And honestly, I think the most important thing, there are lots of different kinds of life insurance. We'll go into that a little bit. Make sure that you have enough for the beginning, because you'll probably need more insurance in the beginning. As your assets grow, you can maybe have less or have different kinds of insurance. So that's really important. So, we look at the gap. What assets do you have? Is your spouse working? But don't count your retirement money in terms of an asset that your family can spend. So again, that's a study that, again, is best done with an advisor to help you figure out what you need. And then there's other short-term needs too, final expenses. Replace the stay-at-home person, male or female, whoever it might be. And so those needs come up too, and those are immediate needs. The other, the 2.5 million is to make sure they're okay for a very long time. So other benefits at work, again, that's great. Very inexpensive to buy, but they don't go with you when you leave. The same as disability insurance. It's not yours, but certainly get what you can to supplement for the time being, but understand that in the big picture, you need to have enough so that you're comfortable if those benefits go away. Your investment portfolio, that would be money outside of your retirement plan. It goes up and down. If you have a certain amount of insurance coming in, you're going to get that. So you don't have to worry as much about the timing of your investment portfolio. And again, the next one is really legacy. do you want to be sure that your family through the generations has a legacy, has money from you? And that's where life insurance comes in also in the long run. Or if you want to give something to charity so that you will be remembered after you're gone, plaque on the wall, or whatever way you want to be remembered, to donate to charity. And then final expenses, really important expense. I mean, it's very expensive to have a funeral and everything else that you need at the actual beginning when someone passes away. You have obviously the funeral, which is, I think, around $20,000. You have debts, you have a lot of expenses that come in, and time. So you probably need time, or your survivors need time to figure out what to do. So at the very least, you'd have the insurance that would give them time to do that, to figure it out, and then start a new lifestyle that would be comfortable for them. So what kind of life insurance? There are many different kinds of life insurance. I can't stress enough how important it is to get enough so that your family's covered. So that, that is, I think, a very important consideration. So there are two types. You can rent it or you can own it. Now, it's really a great advantage to own it. It's like owning your house because it's an asset, keeps growing, can't get thrown out, but you do need a roof over your head. And if you cannot afford that house, then it's important to get enough temporary insurance, that will keep your family covered. So the basic types are term and permanent. Term insurance, again, it's renting it. You can buy a lot of insurance for a smaller amount of premium, but it will end at a certain point and you will never get the money back that you put into it. But again, it's going to create comfort for your family. Then permanent life insurance has great advantage because it will give you an added bank account, cash value, that will accumulate as time goes on. So if you buy permanent life insurance when your child is born, you will have money to send them to college by the time they're 18 or so. So this is really an investment in a living investment as well. It will cover your family and it will also help you as time goes on. However, the premium is higher. And I think going back to let's see what you need and then let's see the best way to buy it. And so what many of my clients do, they're starting out, they've got two little babies, they're not earning much money, they get term insurance. Then as time goes on, they can upgrade and they can move it over to permanent insurance with no underwriting. Again, the underwriting is really part of this because you still have to be healthy to buy insurance. So if you buy term when you're young and you get a great rating on it, that will translate over to other insurance that you can use when you're ready to upgrade. So again, it's, this is really important for the beginning to get the death benefit there. This owning cash value insurance will give you, part of your retirement portfolio as well. So look at term insurance, temporary, it's affordable, but then it also gives you that upgrade capability and you can make a combination. I know when I started my insurance, I had term, I had whole life, and then I moved over from the term to whole life at a point at which I never would have gotten a preferred rating. So I was glad I had it because when I took out the term, I was in incredible health. So that was good. So again, it's something, an insurance portfolio is like any other portfolio. It's a moving target, and it's important to look at this periodically with an advisor to make sure you're on track. Is it time to change some over? Do I need all of this term anymore? Maybe I'll change some over, maybe I'll drop some. So again, it is part of a planning situation. And universal life is, you may hear about it, it's a little different from whole life. It's based on interest rates or investing in mutual funds. Generally, it will give you protection and some other options in terms of the way the cash value grows. I don't really want to get too much into that, but it is, again, it can be permanent and it can give you a really substantial cash values down the road. So permanent It's called whole life because it's coverage for your whole life. And this is New York Life pays dividends. What happens is the company pays a dividend based on its experience and its evaluation of its risk pool, so that is some of the cash value is guaranteed to be paid, and some of it is based on the dividends from the life insurance. And it's pretty safe bet that they will continue to pay dividends. Again, in this area, I would look for a company with very strong financials because that's really where it's based. And so the premiums are guaranteed. They will never increase. Cash value, it's like a bank account. If you need money, you can just borrow it from the life insurance immediately. So the value is, I want to go to this one. Okay. If you have had a policy for a while, you have in association with it a fund, a cash value fund. You can borrow that if there's an emergency. And a lot of people set these things up early so that they can withdraw for education. And little factoid that when you apply for financial aid, the life insurance cash value is not considered an asset. Whereas your child's 529 plan, your other assets are considered available to pay tuition, which is now running, $30,000 to $60,000 a year from what I saw this morning. So that if you do apply for financial aid, that money is protected. You can use it obviously if you want to, but it's not part of the equation. And let's say you want to buy a home and you need a loan really fast. You can borrow money from that cash value, put it back. No one knows about these loans. I think that's very interesting because if you go to a bank, you have to do full disclosure, etc. Life insurance, you make a phone call, the money's in your bank in a couple of days in terms of borrowing from your life insurance. So that would be for a new home. And then retirement, I'm assuming everyone's living through this, and this is a benefit that you will have as a living benefit. You will have accumulated money in that cash value. And if you want to take it out, it has a great advantage over just about everything else because you can take money out tax-free from your life insurance policy. So in a way, it's like a Roth. Now, many people don't have the opportunity for a Roth. The income's too high for a Roth. A Roth is a retirement plan where you don't get a deduction up front, but your money grows without taxation. That's deferred growth. And when you take it out, it's tax-free. So that is one of I think, the great advantages of life insurance, which comes into play when you retire. So that if the market is down, maybe you'll take money from your cash value that year so that you're not locking in the losses that you have in your portfolio. But this really shows you, if you're taking $100,000 out of a 401k, it's all taxed. Let's say your tax rate is 22%. So what are you really getting? You're getting $78,000 to spend. However, if you take some from your 401k and some from your life insurance, and this is life insurance that you've probably had a while because you have $50,000 in it, then this is taxed. Your tax bracket might be lower. The 50,000 is taxed at 12%, and there's no tax on the 50,000. So now what have you got? You've got $94,000 to spend instead of 78,000. So, when you retire, it's really not about, oh, how much money do I have? It's about how much money can I spend after I pay those taxes. So this can be a tremendous boon to retirement income and retirement planning. And that can really help. Let's see if I don't have the time. Okay, I'm good. Sorry. Stop wearing a watch. All right, so we're good to go. Okay, then a couple of other benefits here that I'd like to talk about is, why do you need life insurance after your kids are grown, et cetera, et cetera? Well, if you're married and you both have Social Security, the survivor will get the larger of the two Social Securities. If you've both been working, there's still a loss of one of those Social Securities when someone dies. So let's say you each have $30,000 a year in Social Security. Or, okay, let's say the person who dies has 40,000, you have 30, you now have $40,000 a year instead of $70,000 a year. So that is one of the reasons to keep some life insurance going during retirement, to replace the loss of income of someone who, who had that income coming in. So that's one of the other reasons to do it. And I don't know who has pensions are becoming rarer and rarer, but there's still pensions around for government workers, for teachers. And when you retire, you make a choice as to what your pension option will be. Generally, it will not be no beneficiary. I mean, that also has to be signed off on by your spouse. But setting that aside, you can have more money in retirement if you forego some of the beneficiary benefits. So there again, if you have life insurance, that can fill in that gap and give you more money in retirement, because you'll also have the cash value. But again, this really needs to be set up before you're 65 years old, because you need time for that to grow. And the premium, if you're 40, is a lot less than when you're 65. So in terms of thinking about planning and the future, you may want to consider to have some in place to do that. We call that pension maximization, so that your pension can give you more money because they will not be dealing with the, the concept of giving money to a beneficiary. And if there's a big age gap, there is a huge difference. Again, every pension plan is different. Some of them it's not that different, some it's huge. Usually if one spouse is much younger, then there's a big gap between having the beneficiary or not. Usually you have partial beneficiary. So the next step is, how do you get started? There's a lot to be learned to take into consideration here. I think it's important to know your numbers, because you've got to know how much do they need? How much do you need in terms of income if something happens, be it disability, be it death, and your assets, because that can offset some of it, maybe. And what insurance to have in place. In a way, I would not count the insurance you have at work, because you're probably not going to be working when you're more likely to pass away, which is after age 65. So you need to know that insurance that you want to keep is there forever. And expenses. It's interesting because I found that whenever I sit down with people, some of them know every penny they have, every penny they earn. They know what insurance has. They have no clue as to how much they spend. And that's very important, because that's really what you're replacing. We say you're replacing your income, but you're really replacing the ability to pay your expenses. So that is an important thing. And it's very useful to sit down and go through this process. It doesn't have to be the last penny, but to really know, and then to really understand the gaps. What happens if your income stops? What happens? Think about it. What would I do? How would I pay my rent? What would happen to my family if I was disabled or I died? If I've retired and I've got another couple $100,000 of expenses, I didn't expect to retire and have, $500,000 of expenses. I thought, it'd be modest, but then you add on another few hundred for long-term care, and that really is a difficult problem. So that's the gap. And I think understanding that helps. And it really gives you peace of mind. This is maybe a little scary to think about it. On the other hand, if you know that that's in place, insurance buys peace of mind. It buys time. It buys, maybe you don't insure everything, but if you know that if your spouse, significant other, or whatever passes away and you have a few $100,000 in life insurance, you have time to figure out what to do. And sadly, that actually happened to a client of mine. Her partner, her wife, died so unexpectedly. And because they had taken out some life insurance, my client was able to get through a year or so, not work, take care of her young son. And it just made all the difference in the world to just have that. and I think that's really important. So it does give you that peace of mind. And you need to work with someone that has, that you trust, that understands what your goals are. It's not an abstract situation, and who will go with you and stay with you and keep reviewing what you have, because life changes. I mean, you may need a lot of coverage now temporarily, or possibly you have a huge estate and you're worrying about estate tax. Life insurance can fill in some of that gap. Also, if you get it early enough and keep it like a whole life policy as long as you're alive. And then Savvy Ladies is there to help. So if you have specific questions and all, they can help you through the hotline. And Judy, do they have information on how to get to the hotline and all that? Yep. Okay, good. So let me know, what questions can I answer for you? I hope there are some in the chat, because that is really important. And I thank you all for coming and sharing this time. So do we have questions? Judy, I think you're muted.
No, I'm not seeing any questions. I'm seeing some chat sharing about what happens at age 65, sort of the definition between long-term care and insurance. Do you need both? If you can chat about that maybe and answer that question.
Sure, absolutely. Generally, I mean, obviously there are differences, but most of the time people need long-term care as they get older. Doesn't always work that way, but that is something I think most people would look at in their 40s or 50s, because the cost of it gets to be higher as you get into your 60s. And that's when most people are looking at it, because they've had experience with their relatives. But if you set yourself up earlier, then you will pay less for the rest of your life. And also you'll have your health. Because in terms of, getting insurance, you need to go through that process of underwriting. And unfortunately, as we get older, we're more likely to have something. May not bother us now, maybe something that underwriters don't like that doesn't bother us, but nevertheless, it does make it harder to get insurance as you get older. But I think, in terms of what happens at 65, is that maybe a target retirement age. Your full Social Security doesn't kick in until you're 67. So that's another consideration. Depends on, of course, your age, but for the most part. And, I would think about the long-term care situation as early as possible. But in the very beginning, I think the disability income is protecting your whole life ahead of you. And life insurance for your family, which would be most likely some term. And then as you go on, you can see the value of keeping insurance longer, and some of it might kind of morph into a whole life policy. So you'll have the advantages of the policy later on in life, and know that if you don't want it, at some point you'll get all your money back, which you will not with term. So it really is a continuum. And people are retiring at different ages. 65 is no longer the magic number. So who knows?
And Katherine, there is a difference, just to clarify for everyone. Life insurance is different from long-term care insurance,
Absolutely.
Correct?
Yes. Life insurance will pay a benefit if you die to your family. It has a component of cash value if you get whole life insurance. But the main purpose of it is to keep your family in their lifestyle. Long-term care insurance pays if you're chronically ill, and that can really affect your retirement lifestyle and your family. So
they're two separate policies.
They're separate policies, although just to make things more complicated, there are hybrid policies now where you have a life insurance policy, but there is a component of that policy that will pay if you need long-term care. So that has become more popular because it will help you one way or another, help your family one way or another. But like most combinations, you will get the most coverage for long-term care with a standalone long-term care policy. So that's, again, a decision that everybody makes on their own. And again, the long-term care is going to have a much lower cost the sooner you buy it. And it should have some way of inflating the benefit as the cost of care, increases, because it's not going to stay where it is. Nothing is really.
I'm going to ask everyone who has a lot of personal questions to come to the helpline, and we can answer many of them there if we run out of time. As there are some questions here, Katherine, that are coming up in the chat, which might be the confusion between life insurance and long-term care. It's saying, I'm going through a divorce. I'm getting support. Should your ex take care? Should your ex take out life insurance to protect you? How should life insurance be planned in a divorce is the question.
That's a great question, because a lot of divorce agreements or decrees have that built into it. If you have some form of payment that's due you every year, what happens if your spouse dies? Do you have to go after the estate or his new wife? What? So the life insurance is very often built into the agreement. And I think it's significant that you have some control over the beneficiary, so that either you would own it or the beneficiary would be what's known as irrevocable, so that your ex can't just go and change the beneficiary on the life insurance.
Yep.
So yeah, that is a very good question. I think it's important because you don't know.
No, very good. And I just want to clarify to everyone, because I see some questions coming up in the chat that are asking more about long-term care and being, say, disqualified for long-term care, or what should they do about long-term care, and what is that? How is that different? So I think, Katherine, we've identified that there's long-term care and then there's life insurance. And people should understand the two as different policies. There are hybrids, but they have different purposes.
Totally, because long-term care insurance protects you against an illness. Life insurance will provide money to your heirs if you die. So that's the basic difference between them. And, they are different at different times of your life too.
Correct. And I want to just share a personal story in that caring for my mother, who did have life insurance, there was a point as she was aging where she was paying both life insurance and long-term care. And we said, Mom, your children, you have no one to cover any longer for life insurance because your children are all employed. And the only person really is to take care of you, and what taking care of you is long-term care. So put your money towards paying your long-term care policy. And at that point, as she was aging, she stopped the life insurance so she could pay the long-term care. So again, recognizing and understanding it's two separate needs, and who are you protecting? And now with long-term care, there are hybrid policies too, that long-term care can then also be sort of the insurance that it's not use it or lose it. If you don't use it, it could become that insurance to go to your heirs. So again, many things to look into as different options that fit your needs personally and your family's needs is what I recommend to all the listeners and people joining us here on today's call. And do use the helpline so we can speak to you about your own personal question and help you through. Katherine, this has been a great seminar for you to share, because life insurance is really important, and especially going through those life stages when you are a young couple, when you are taking care of family, you need to plan out so there's a future for continuing that payment for you yourself. If should you be disabled or not able to work, life insurance is a key protection, as you said. But also understand there's long-term care, and we cover that in some other separate seminars. And both are necessary at different points of your life.
Absolutely. That's it. And please don't forget about disability insurance, because that is the beginning. If you are disabled, you don't have time to save for retirement, pay for your kids' education, whatever. So that too. But these are three different ways of protecting and finding peace of mind for different aspects of your life. And I think, that's the point. And I think, really thinking about where you are, where you want to be, and sitting down with an advisor is truly the way to go to get started.
Yeah, really great information. So we're right up to the top of the hour, which has been terrific. Thank you, everyone, for being here and learning with us today, because that's what it's all about. Savvy Ladies is all about learning and asking questions about your financial health. And it is scary, but we're here to help you through it and help you make the right decisions. As you see, there are so many different choices, and we want to help make the right choice that's right for you.
Thank you.
So thank you, everyone, and see you at the next program that we do.